Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name's Michael, and this week we'll be talking about the space industry. The ongoing feud between Trump and Musk was a reminder of the stakes involved in the space race. So we thought this would be a good opportunity to write about the industry. Now, while SpaceX isn't listed, there are a growing number of other companies in the value chain. Plus, it's an industry that has a massive runway ahead of it. So it's worth getting to know if you're a long-term investor. And after all, if you're here with us, we're hoping that applies to you. Before we blast off into the cosmos though, let's quickly touch down on what happened in the markets this past week. Now, if you want to skip ahead, just use the chapters below to dive straight in. First up, Circle, the stablecoin firm, made serious waves with a jaw-dropping IPO. The company's shares surged from $31 to $117 in just 2 days. A staggering 247% rise that caught Wall Street's full attention. ARK Invest moved fast, scooping up 4.5 million shares. Why? Well, they believe stablecoins, often dismissed as crypto footnotes, are being recognized as critical infrastructure. Think of them as being next-gen financial plumbing. Even tech giants like Meta and Uber are reportedly considering stablecoins for cheaper cross-border transfers. Circle's infrastructure, USDC with treasury-backed reserves and global reach, could become the bedrock for exporting US dollars via blockchain, especially in emerging markets where there is demand. This IPO isn't just a hype spike, it's a signal that stablecoin infrastructure is finally investable and taken seriously. Next up, Microsoft and Asus are entering the handheld gaming scene with 2 new Xbox Ally devices. These aren't just glorified mini PCs. They feature a full-screen Xbox interface layered over Windows, aiming to simplify the handheld gaming experience. The idea is to combine console accessibility with PC gaming power. Microsoft's looking to unify its platforms and create an ecosystem that feeds into Game Pass, cloud gaming, and even AMD chip demand. With the holiday season on the horizon, this could be the start of a new wave of mobile gaming. Meanwhile, Snap is stepping into the wearables ring. Its new AR/VR specs aim to challenge Meta, Apple and Google, all vying for dominance in what could be the next big computing platform. But history tells us to be cautious. Google Glass didn't quite take off, and the tech might still be a few years away from being consumer ready. Still, companies know that they have to be in the game. If users shift away from smartphones toward augmented reality interfaces, the platforms that aren't ready risk becoming irrelevant. Over in energy news, the EIA projects a drop in US oil production by 2026. The first since 2020. Factors include lower prices, softer than expected demand, and a build-up in global inventories. OPEC Plus is slowly unwinding its production cuts, but even they undershot May's targets. With little incentive to ramp up, producers are holding back. That sets the stage for potential supply shortages and higher prices down the road. Speaking of oil, prices are holding near a 7-week high as investors digest US-China trade talk progress. Demand expectations are buoyed by easing tensions and domestic consumption, especially from Saudi Arabia. But the market remains cautious, looking for firmer signs of sustained global demand before pushing higher. And lastly, on the geopolitical front, China has resumed rare earth exports to the US, but there is a catch. Licenses now expire in 6 months, giving Beijing a pressure valve if talks go south again. In exchange, the US is easing restrictions on jet engines and ethane exports, both critical for China's manufacturing base. This isn't a lasting peace though, it's a tactical pause. Companies in defense, electronics, and EVs should prepare for volatility and diversify their supply chains accordingly. Now let's dive into the booming space economy. In 2023, the space economy hit $630 billion. By 2035, it's expected to reach a staggering $1.8 trillion. What's the rocket fuel behind this? Well, Wright's law, the principle that costs fall as production scales. We've already seen it play out. Launch costs have plummeted over the past 15 years, while satellite launches surged from just 120 in 2010 to nearly 2,900 in 2024. More satellites mean more data, and with AI in the mix, we're extracting even more valuable insights across industries, from insurance and agriculture to defense and logistics. As of 2025, there are over 11,700 active satellites in orbit, 70% of which belong to Starlink. Researchers estimate that low Earth orbit can handle up to 100,000 satellites, though the returns from adding more may decline before we hit that number. Geopolitical tensions are making space autonomy a priority. Europe's dependence on Starlink is seen as a vulnerability. As alliances fracture and defense budgets swell, expect to see more investment in satellite networks, surveillance systems, and unmanned drones. As for space tourism, it's here, but it's not really taking off. Virgin Galactic's share price has dropped more than 99.5% since its 2021 peak. With ticket prices around $600,000 for a 15-minute flight, and the company burning $500 million annually, the economics just don't work. Well, not yet anyway. More intriguing are the longer-term frontiers: in-space servicing, lunar mining, and manufacturing in microgravity. These might sound like science fiction, but they are slowly inching towards reality. The space value chain is typically split into upstream and downstream segments, much like oil and gas or telco sectors. Upstream players are involved in creating and deploying space infrastructure, basically the design, manufacturing, and launching of space assets. Meanwhile, downstream players use the data and infrastructure created by the upstream players. They leverage space assets for services and applications on Earth. Let's start with the foundation, the hardware and systems that make space activities possible. Upstream is all about infrastructure: rockets, satellites, and spacecraft. SpaceX has transformed the game with reusable rockets and 70% faster turnaround times. Rocket Lab is the only serious challenger, with 63 launches compared to SpaceX's 500 plus. Other players include AeroVironment, Intuitive Machines, AST Mobile, and Planet Labs. Legacy aerospace giants like Lockheed Martin, Boeing, and GE Aerospace continue to provide critical hardware and have the balance sheets to weather any turbulence. L3Harris Technologies, which is slightly smaller but equally crucial, is a major defense contractor with robust government contracts. As for ground systems, like antennas, software, and data centers, they keep it all connected. Kratos Defense is a standout here, with a diversified offering across air, land, and space domains. Now, downstream is where space becomes revenue. It's about applying satellite tech to real-world services. Iridium powers remote comms. EcoStar delivers satellite broadband and TV. MDA Space and Black Sky offer Earth observation and analytics. Trimble and Spire Global provide GPS-based tracking, weather forecasting, and geolocation services. Okay, so with all that covered, what's the insight here? A high-risk, high-reward sector like space lends itself well to a barbell strategy. This means balancing stability with a few calculated high-growth bets. Here's an example. On one side, you could anchor it with stable, cash-flow-rich companies like L3Harris, Boeing, or Lockheed, your picks and shovels that keep the sector running. On the other side, allocating a smaller portion to Moonshots, new space companies with high growth potential but higher risk. Think of firms like Rocket Lab or AST Space Mobile as potential 10x baggers. Some will do well, while others will do very poorly, so diversification is key. Spreading your bets across launch services, satellites, and data plays can work well to hedge your risk while capturing upside. While you can't invest directly in SpaceX yet, you can get exposure via funds like Destiny Tech 100, though it's worth keeping in mind it trades around 6 times its net asset value right now. We covered that fund many months ago, so check out the article if you'd like to read more into it. ARK's fund is a more fairly priced alternative, but with less exposure to SpaceX. As for next steps, check out the company reports of some of the companies mentioned to get a better idea on their prospects. You can add any of them to your watch list and be notified when important updates happen. Also, look for some narratives on these stocks in the community section from other investors. There are some great insights there. And lastly, if you allocate any capital to the space industry, make sure you're happy with the percentage allocation in the portfolio tool and gain other insights on how it sits amongst your broader investments. Space may be volatile, but its trajectory is clear. For long-term investors willing to withstand a bit of turbulence, the opportunity is, well, astronomical. That's it for this week's Market Insights. Thank you so much for listening. And if you have any feedback, please do let us know. We'll be back next week with more Market Insights. But until then, invest well.